We've helped hundreds of clients build better construction companies.
We love this business, we love the people, and we've seen what running a successful, profitable business takes.
And we're sharing it all with you here on Construction Hot Takes.
All right, so on today's episode of the Hot Takes podcast, we're going to be talking all about PE, private equity, from the contractor side. What does it look like? What is private equity actually doing? What does that mean when I hear private equity? Why would they want to buy me, or how do I get them to buy me? We're going to talk about all that and more on today's episode.
So today, we were talking the other day about what we were going to talk about today, and we remembered there was a Wall Street Journal article published about a month ago, maybe, right? That caught all of our eye, and so it's about the article basically is about this. It's titled "America's New Millionaire Class," and it's about private equity buying up mom and pop, primarily HVAC, plumbing, and electrical companies. But it talks about what's happening in that space now. So we work with private equity, and we work with our clients quite often to help them be ready to sell or transition or whatnot. So I thought it might be a good topic to kind of go through today to talk about what does that look like from the contractor side to what is private equity and how does it work, and what do you need to do to make your business look attractive to if you're looking to maybe bring in equity or sell out entirely.
So I think a great place to start, Greg, would be for you to explain the difference between private equity, investment capital. Like there's a few different ways we see it with our clients.
Yeah.
So maybe you could expand on that to start.
So I think if we talk about private equity, it can be an umbrella term. It can be any outside investment, that's the private part. Any outside investment of private money into an external business. So we call it private equity because that's kind of what it's known as, right. But it literally just means private money coming into your business. The equity part is what's interesting, and that's the split. There are really two breakdowns of private equity. One is, which is called equity, when you give someone money for their business and you take an ownership in that business.
Right.
The owner may stay, the management team may stay, they may go. It doesn't matter. But the fund or the firm or the company or the investor gets a piece of that business. And the other part is called direct investing or direct lending. Mm-hmm. That's using private money from a group of people who have money for this. They put money into the business as a loan. Mm-hmm. You don't own the business, but you're still there. You're like an advisor almost, but you don't own part of the business. You're kind of giving them money for them to continue to run their business, maybe with the goal of selling to someone else, or maybe just because it's easier to get money from a private equity of a return from a private person than it is from going to a bank. Yeah. So those are the two main breakdowns.
In Silicon Valley, a lot of times it's like angel investing or something like that, where they're coming in and they're infusing capital into a business to help grow it. They get maybe a profit share, but they don't get any ownership.
They're not going to, and
that's the difference.
And you just said the other thing to keep in mind is a lot of people will hear the term or will know the term venture capital.
Yes. That's
a little bit different. Venture capital is putting money into something that is untested, untried, untrue. Like
a new business, an incubator kind of thing.
Exactly. I invented this new thing and let's try to raise money for it to go make it work. What we're talking about is private equity money. These are businesses like our friend in the article. He was a plumber. He ran his business for 10 years or whatever it was, and he just ran the business every day. And one day he didn't know what was going to happen, and one day someone said, hey, I'll buy you,
right,
and you can stay on, and I'll give you money. But that business already existed, right. So it's not a venture, it's a sure thing.
It's an investment.
Right, it's an investment in something that already exists, and that company then takes that money and continues to do what it was already doing.
We've had a couple of these clients where the private equity firm or group, bundles a lot of like businesses together. In the article's case, It's HVAC and plumbing.
Yep, we've had probably a dozen of those over the last couple of years.
The article points out that since 2022, so let's just say in the last 2 years, just what's reported is PE has bought 800 different HVAC, plumbing, and electrical contractors over the past 2 years.
Mm-hmm.
And that's probably underreported, I'd imagine.
Yeah, well, I mean, our our research we were doing last week, we know that there's at least 300 private equity or investment companies that invest in the construction and trade service sectors.
Right.
So if you think about that, that's only 2 or 3 acquisitions per year per fund, which is not a lot over that time period.
Sure.
There's 800 in the last few years. I mean, that's definitely underreported. I know that most of the ones we talked to are buying up, one every 2 months. They're acquiring a new logo. That's kind of the goal.
Yep.
They're acquiring 5 to 10, smaller companies per year and rolling them into their portfolio.
Yeah, they're businessmen. They have money in the fund, and they're looking for deals. And when they find the deal, they strike.
That's correct.
If they can find them. So that's another interesting part of this.
There's brokers out there that are helping source.
So I was going to ask. So
Yeah, there are.
how does it work? So I'm a contractor, and I might want to get bought. How would I know that? Like, can I advertise? Is there how does it work?
There are business brokers. You would typically hire a business broker who has access to these sources, and then they basically put you, they shop you around. They put you up for sale. We've worked with, there's that company we met with a few years ago, Generational Equity.
Yes.
And they put on an event, and they invite local business owners to come in, and they talk about, we'll represent you, we'll take you to market, and we'll help negotiate for you, and we get a percentage of the sale price.
Right. There's firms that specialize on the sales side, and there's firms that specialize on the buy side.
Correct.
And there's firms that specialize in what they're looking for also. So there may be a private equity fund that only buys a certain type of business. They only buy
Plumbing
manufacturers.
companies.
They only buy food companies. But there are companies that only look at, or not only, but they focus on construction, whether
They
it's...
know that sector.
They know the sector. So they're familiar with that, and they probably target a certain type of business too. So in addition to what Adam said, they also... It's the private equity funds that are also out in the world. They're looking at businesses. They're looking at their geographies. They're looking. It's kind of like a reverse broker. Who do we like? Who may be for sale,
Right.
and who has not yet for sale, but because we haven't given them a number yet, they haven't thought about selling. But now we're going to bring this to them and talk to them.
Private equity does cold outreach.
Yeah.
We have actually received inquiries about our company. Like, hey, are you interested in selling? Have you got a succession plan? We represent investors who are looking to acquire a service company like yours. Would you be interested in starting a conversation? It's just the same cold outreach that other businesses would do.
Yeah.
Private equity is doing that themselves, as well as using brokers.
It's like those text messages. Have you guys ever gotten the text message? Hi, I see you live at so-and-so address. Are you interested in selling your house?
Oh, right.
Yes.
It's always, I guess it can be real. But in this case, it's sort of the same thing. Like if your business is even a consideration for them, because they have a criteria that they're looking for. They're looking for a sector. They're looking for a geography. They're looking for recurring revenue. They're looking for a certain size. Yeah. If you're out there, like our friend in the article here, like I said before, we don't know how it came to him, but he was a plumber doing his business for 10, 15 years. He got on someone's radar. Or he went out to a broker and said, you know what, I'm ready to be done with this every day. I don't want to be the only one in charge.
Well, he was clearly doing a good job of running the business for private equity to see that as an attractive business, that they, the financials were there, or they saw runway on his revenue, or both.
Yeah,
Right.
and I don't remember exactly about what Aaron Rice did, but I know that we have clients where when they sell to private equity, they, like Greg said, some of them stay involved as legacy ownership, and they run the business, but they're part of the growth plan for the private equity. We have other ones where the owners are exited, and private equity installs new management to run their business that they've now acquired. And then the third one that we saw in Texas and Florida last year or 2 years ago was they bought the company, and the owners of the electrical contracting company then became shareholders in the equity fund. They got a piece of the parent company now, so they stayed on to run the business, and they now are on the board of the private equity company.
In this case, in the article's case, he and his business partner stayed on as employees,
Right.
not equity owners, but as employees, which I imagine was part of their payout, because it's a salary for a while. And he had I think 4 or 5 years. He was going to be prepared to retire. My favorite, I have to read this because it's the best part of the article. When he says he's going to retire at 50, mind you, I want to hunt, fish, drink beer, and cook meat. And it's selling the company gave him peace
Sounds
of
like
life
a
for his
plumber.
family.
That's-
I think that's awesome.
So that's an interesting segue for this. Adam and I worked on a project together about 18 months ago now, maybe 2 years, where this private equity money, their whole model was, do they stay, do they go? Like meaning the ownership. Sometimes what they look at is if the owner wants to stay, that's why they want the company.
Yes.
Conversely, they think the owner wants to stay and they want the owner to go. They know it's not working with that current owner. They have to get rid of that person. So that's part of what these firms are looking at. Like, what's the best thing for our investment? Sometimes it's staying, sometimes it's going, sometimes it's a combination of the two. You could stay for a year and then leave, or you could leave on the first day.
That group I worked with, I think it was a year and a half, 2 years ago, their model was they specifically looked for the owner. They wanted an ownership that was prepared to exit, and they had a second in command, chief lieutenant, whatever you want to call it, young and prepared to buy in. So they would let that second in command, that person that was, they had a ceiling because they didn't own the company. They let them put some sweat equity into the business, make them a minority partner because they know the business, and then they train them up.
Yeah.
So it's a little bit of a different twist on that model.
I think
It
the other
works.
thing that's really important to point out is that private equity never buys a business and wants to keep it the same. They are investors, they're looking to buy a business that they can grow.
Yeah.
They want to typically 3x, 5x, 10x the company over a period of time.
Yep.
And then they're going to turn around and sell it to another firm because they've now gotten their money out of it and made their return on it, and now they're ready to turn it over to the next company. It's almost like doing house flips in my mind. Like you buy a small house and you renovate it and you flip it and you get 2 to 3 times your investment back. Well, the next person that buys it does the same thing. They expand it out, they put bigger upgrades in, and then they turn around and they sell it 3 to 5 years later. So these are investment vehicles for these companies. They are not looking typically to be owner operators.
Right.
They are investors looking to buy an asset that generates revenue, that generates profit. They can then grow that business, get their money out of it, make their investment back plus a nice return, and then after 3, 5, 7 years, they're going to turn around and they're going to sell it.
Yeah, it's a finite operation.
There's
whether
very few that hold them
for long term.
indefinitely.
If you were to look at a PE's portfolio with construction holdings if you just pick a date on the calendar, 5 years later from that same date, it would be different. Some would have been sunset, some would have been divested, some would have been invested in. So it's an ongoing thing. And if you read any, like the news, you pick up the news, so and so firm bought this company today. Right? And then so and so firm sold this company today. Whether they sell back to it might be an ESOP, they might sell to a different private equity fund, they might sell to a new buyer, like a new private buyer, but that's the whole model. You don't ever want to get stuck in a business that you've put time and money into. You grow it, you scale it, you have better margins, and then you exit.
I just thought of another analogy that might make a lot of sense. It's like a mutual fund. So there's a fund manager that buys stock and sells stock inside of that fund. He's constantly rebalancing the portfolio for maximum performance. This is very similar in that they're buying businesses and they're building a portfolio of companies to generate profits. And if one business starts to fade or they've grown it substantially, they're going to get out, and while the getting is good, they're going to buy low, sell high. They sell one asset out, one logo out from the fund that they're managing, this private equity fund, and then they're buying something else. So they're constantly rebalancing, or ongoingly rebalancing. I don't know if constantly is the right word, but they're frequently, we look at this, we can see the activity, we can see they held this one for 5 years, then they sold it. They bought this one 18 months ago, and then they've got 3 more that they've acquired. They've sold off these. You can see the timeline of how they buy and sell assets.
If I were thinking about an exit plan, and maybe I wanted to make myself attractive to private equity, whatever the model happens to be or whatever, I'm ready to exit the business, what should I be doing, or what do I need to do to make myself attractive to an outside investor?
I think the most important part of that question is you need to do your research first. I think we touched on this. There are a lot of private equity firms. There are a lot of investors in the world who look at construction. It's not 5, and you have to fit into one of those boxes. So I think the first thing that you do is do your research on to whom do you want to sell. If that's your exit strategy, you want to sell to private equity. And number 2 is understand what they're looking for. Don't go to a firm that wants you to stay. Right, that's their model. If you want to spend 6 weeks there and then you want to turn everything over and then you're out, that's not what that firm wants. They want you to stay for 5 to 7 years. That's probably not the right person for you. So I would say research these private equity firms that buy construction companies and find one that fits into what you already are.
So understand there isn't one size fits all. There are lots of different options.
Size, number, geography, all that. Yeah.
Now, what is the private equity firm looking for in investment? There's a few things we hear that we see. They're looking for, one, stable management. They want to know that if they buy this company, management's not going anywhere. The day-to-day operations, people, maybe ownership leaves, but they want stable management. Second, they are looking at EBITDA, and they're looking at recurring revenue, and they're looking at profit margins. So they want to see a recurring revenue stream, maintenance contracts, things like that are bankable, that they know that revenue is coming in.
They want to see a revenue runway to know that it's
Okay. They also want to see, they love service businesses because the service side of the business is such a high profit margin compared to project-based work.
It's repeat revenue.
And that's the recurring revenue, exactly.
It can be. It can also be, that they do a lot of service calls, house calls, maintenance calls.
Mm-hmm.
Just those, something's broken, they pick up the phone, they call, and they get your service department. Think about the company in Rhode Island. They had a huge service side of the business, and it was not all scheduled and maintenance contracts, but they had enough volume in the area, the geography they serviced. They were like the number 1 HVAC service company.
Right.
It was like I needed something done in my house, and I picked up the phone. I called Cool Ray because Cool Ray is everywhere, right? Service-based business. They love the profit margins on service. They love recurring revenue. They love long-term stability. They like to know that they're buying an asset that just because they bought it isn't going to suddenly stop performing. And they also like businesses that are systematized, that have repeatable processes. They look for that because that makes them scalable.
Right. So if the founder or the current owner isn't there, whether they're staying on, they're probably not going to be there long term either way. But if they're not staying on, the private equity firm wants to understand, well, this business will continue to run. If the founder exits him or herself, or we exit them, I need to know that this business is going to keep running, right?
And I would add one more thing that's really important. It seems implied, but we should say it, is that you have to have accurate financials. They don't have to be perfect. They don't have to be the best you've ever, because sometimes, a PE firm wants to come in and make things better. They want to put you in a different system. They have a different model for but you have to have financial statements that are accurate, that you can turn over to the firm, and they can look at you and say, okay, this company is what they say they are.
So
get your financials in.
Showing some consistency.
And
accuracy,
in order, and well done, and accurate, and timely. Those things matter.
Typically, if you're gonna sell to private equity, they're gonna require audited financials from you, not just certified. They want audited by your CPA. They want your CPA to have signed off on them. So they're going to want to see an accurate WIP schedule. They're going to want to see that over time. They're going to want to see a couple of years.
So I got a question. So I'm still playing the role of I'm this I have a mom and pop shop.
Yeah, you're an HVAC contractor.
Right. So they're going to ask me for these financials. Like, I don't want to give that to just anybody. How do I protect my business and my livelihood? Do I just give that to them, or do I need to get a lawyer, or what should I do?
Typically, you need to get a lawyer, and the broker would help you with this, but you're also going to typically sign some sort of an NDA, a non-disclosure agreement, that this is all confidential information is being shared in the interest and pursuit of a business deal, and if the deal doesn't go through, then the private equity is supposed to tear it all up and dispose of it all.
And the phrase that some of our listeners have probably heard, the phrase is called due diligence. That's what that's called. It's the first step in the process. It can take a month, it can take a year, but that's vetting who you're buying and being vetted by who's going to buy you, so that you can turn over everything, be accurate, be honest, be who you are, and if they want you, they want you. If you want them, vice versa. If they don't, there are other fish in the sea. If
either one of you could walk away at that point and say, I think
it's just a bad fit.
Right.
Yep. Yeah. And that's one place where have gotten calls and been brought in as to assist with the due diligence process.
Yeah.
They brought us in because the private equity understands the business side of it. They can look at the numbers and the math, and they can sit in there and ask questions, but they typically don't have the day-to-day construction operations experience that somebody like us has. So they bring us in to help with the due diligence process, to help explore, understand how is this business actually operating, and how is it going to operate if the owner leaves, if we exit him, if we buy them and try to 3x the company, what systems are going to break, what other roles do we need to hire for, what software is going to be insufficient. So getting into all of that's part of the due diligence process that we can oftentimes assist with on both sides. We can help the HVAC contractor prep in advance to make them more appealing to private equity. Or private equity brings us in to really help pull back the curtain and see what's going on behind the scenes,
Right.
to make sure they're buying something that's going to.
So ideally, I've decided that I'm ready to retire in the next, let's say, 5 to 10 years, something like that. You can help me. We can help me. That sounds weird. We can help me. We help with processes or just organization. Maybe how to scale the business a little bit so it's bringing in, it has that repeatable revenue.
Technology.
So it's sort of a little bit of business planning and a little bit of succession planning and a little bit of back of house cleanup, maybe some accounting as well, perhaps.
Yeah, getting your house ready to be shown by a realtor
That's a good way to put
is
it.
a good analogy. You don't want to sell your house if it looks like junk on the inside. It might still sell,
And it needs a bunch of repairs. You probably want to get
But you
those
need-
repairs done first.
and you want to paint it, and you want it to be clean, and then you want people to walk through and see it. It's almost the same thing. Get your business in its best light
Right.
and accurate,
To command
for what
top
you
dollar.
are, so you get top dollar, right?
If your house needs a bunch of repairs and it hasn't been painted and it's cluttered, it's probably not going to sell for fair market value. It's going to sell cheaper. So if you want to get out quick, then you're not going to get top dollar. But if you've got a runway of time to plan to get out, you have time to, as Greg said, get the house in order, get it all spruced up and looking its best possible self so that it's worth the most on the street.
Thank you for joining us on our podcast episode today about private equity. Please join us the next time on our Hot Takes podcast, and listen to us anywhere you get your podcasts, on Spotify and Apple Music. And be sure to visit us on our website at ascentconsults.com.